Hello, everyone, and welcome to today's webinar. My name is Anna, and I'm with the New Mexico Small Business Development Center. Today, we have Peggy McDonough joining us, who is a certified SCORE mentor. Peggy holds an MBA and is a CMA with 30 years of project management and finance experience. Peggy will be presenting Are You Tax Ready? PPP, EIDL, and ERTC Implications. We will be using the Q&A function to take questions and welcome attendee participation. So don't hesitate to ask us any questions you may have. We'll answer those questions at the end of the webinar. If you have any technical issues, I can address those within the chat feature. Thanks so much for joining us. And without further ado, I'll hand it over to you, Peggy.
Thank you. Good afternoon, everyone, and thank you for attending. As she said, my name is Peggy McDonough. Let me here we go. And today's topic will be on PPP, EIDL grants, and ERTC. I am a SCORE certified mentor, and SCORE and New Mexico Small Business Development Center are working in collaboration, and we hope to provide small business owners with professional training and support. And so today's webinar is an example of this collaboration, and we hope you'll find your time today productively spent and useful for your business. Do not use the chat function during the webinar because we won't be monitoring it, but you can write any questions you may have, and the slide number, if you happen to have that, in the question and answer feature in Zoom, and we'll address any of your questions and all of your questions at the conclusion of this presentation. So SBDC is prohibited from giving tax or legal advice. So any tax-related questions, accounting questions, and specific questions about your individual company situation can only be answered with credible authority by your accountant or your attorney. And please keep in mind, the information we're covering today is changing rapidly and is based on current understanding of the programs. It can and likely will change. And although we will be monitoring and updating this webinar as new information becomes available, please do not rely solely on this for your financial decisions. We encourage you to consult with your lawyers, your CPAs, your payroll experts, and your financial advisors. So I have several goals today. I'd like you to walk away from this webinar with a better understanding of the tax impacts for various COVID relief programs that have been signed into law by Congress in both 2020 and 2021. We'll be starting with the Coronavirus Preparedness and Response Supplemental Appropriations Act that was signed into law in March of 2020, and we'll be ending with the most recent American Rescue Plan Act, which was signed and extended by President Biden on March 30th of 2021, I'm sorry. We will also cover the impacts of the infrastructure bill, which was signed into law in early November of 2021, because it did impact every single program that I'm going to be talking about with you today. You should leave here today with more knowledgeable and with guidance on what questions you need to be asking your CPA, your tax attorney, or your payroll professionals in order to make the best decisions for your business. So as I mentioned, we're going to focus on three specific programs: the Payroll Protection Program, usually called PPP, the Economic Injury and Disaster Loan Grants, called EIDL, and of course the employee, my personal favorite, which is the Employee Retention Tax Credit. We're going to look at the timeline in the background and what some of the tax implications are, and also some of the frequently asked questions. As I said, we'll end today's webinar by addressing any questions that you may have. So how do we start on this journey? Well, on March 6th of 2020, Congress signed into law the Coronavirus Preparedness and Response Supplemental Appropriation Act. And this act declared that coronavirus or COVID-19 outbreak a disaster under the Small Business Act. And this opened the door for the Small Business Administration to use its lending authority to make economic injury disaster loans, sometimes called EIDLs, for small businesses that were impacted by the pandemic. Quickly thereafter, just a couple of weeks, we had the CARES Act, Coronavirus Aid, Relief, and Economic Security. It was signed into law, and it created the Payroll Protection Program and provided nearly $349 billion for PPP loans. Then in early May of 2020, Congress provided an additional $320 billion in funding. It also introduced the grant to pay SBA EIDL applicants an advance on their EIDL loans. Now, these advances were treated as tax-free grants and did not need to be paid back, and the funds were exhausted very quickly in July of 2020. It also created the Employee Retention Tax Credit, sometimes called ERTC or just ERC. Now, the ERTC is a fully refundable tax credit for employers equal to a percentage of qualified wages. And these qualified wages include health plan expenses. And these are the wages that employers pay their employees. December 28th of 2020, we had the Consolidated Appropriations Act, and it was signed into law. And embedded in that act was another $900 billion in COVID relief. Now, $300 billion in aid for small businesses, $248 billion to this SBA for the first and second PPP forgivable small business loans, and $20 billion to provide additional grants for EIDL grants to businesses in low-income communities. Then in March of 2021, we had the American Rescue Plan Act of 2021, and that was $1.9 trillion. And it was voted on March 10th and signed into law by President Biden on March 11th. And among other things, it provides small business assistance, including specific programs for restaurants and live venues. On March 30th of 2021, they extended the application, was extended to March 30th and passed into law by Biden. Then last but not least, and I've got this in red because this particular bill, although not specific to COVID, has impacted every single program. And it's the infrastructure bill. It was passed by Congress on November 5th, 2021, and it was signed into law by President Biden on November 8th. And I'll go into some of the specific impacts by program to give you an idea of how impactful this particular bill was. So what results when you have all of these acts and all of these bills and all of this money basically coming at small businesses? And it results in a lot of interpretation. What exactly did Congress mean? Because they can be very vague in these bills. And what organizations are impacted? You have the IRS that's involved, you have the Small Business Administration, you have banks, CPAs, business owners, just to mention a few. Now, Treasury and IRS tax laws and guidance have lagged on all of these bills, and they're confusing, and in some instances, they're contradictory. You have new forms, new applications, confusing interpretation in a constantly changing environment, and this means that you as a businessman or businesswoman is going to have to deal with business situations and tax implications that you've never seen before. So first, let's go into the Payroll Protection Program. Now, the applications for the Payroll Protection Program ended in May 31st of 2020. So there's no more money that people are drawing, but we are now in what's called the forgiveness stage. Now, these PPPs loans were designed to provide a direct incentive for small businesses to keep their workers on the payroll. They were 8 to 24 weeks period, and there was a first draw, which was out of the CARES Act, and the PPP loans can be used to help fund payroll costs, including benefits, and may also be used to pay for mortgage interest, rent, utilities, worker protection costs related to COVID-19, uninsured property damage costs caused by looting or vandalism during 2020, and certain supplier costs and expenses for operations. But the money was scooped up very quickly by large businesses, leaving the small businesses unable to apply. And so a second draw was given in the Consolidated Appropriations Act in December of 2020. And that expanded it and focused the PPP loan, and it allows certain eligible buyers that previously received a PPP loan to apply for a second draw with the same general loan terms as their first draw. Now we are in the loan forgiveness phase of this program. A borrower can apply for forgiveness once all loan proceeds for which the borrower is requesting forgiveness have been used up. And borrowers can apply for forgiveness anytime up to the maturity date of the loan. If borrowers do not apply for forgiveness within 10 months after the last day of the covered period, then your PPP loan payments are no longer deferred, and borrowers will begin making loan payments to their PPP lender. You need to apply for forgiveness, and you need to work with your PPP lender. Now, what was developed back in August 4th of last year was a direct forgiveness portal for participating lenders. And this was developed because a lot of the small local banks, if you worked with a small local bank to get this loan, they didn't have the structure to take all the administrative hassle that this requires. So they were struggling. Now, the bigger banks like Wells Fargo or Chase Manhattan, they have an administrative structure that allows them to handle all of the borrowers. So this portal was developed in order to help the small lenders. And the lender has to opt in and into this portal. And if your lender does work through the forgiveness portal, it will cut the time off and is really easy to use. It will cut the time off and get your money, your forgiveness answer back to you much more quickly. So it's a great idea. Now you can find this portal and the access to it on at the SBA.gov website. They also offer free counseling and training events to help you with the Paycheck Protection Program. Now, the CARES Act spells out that the forgiven loan amount won't be included in taxable income. This means you don't pay taxes on the money that you receive. This loan is specifically to provide businesses with the money to keep running and continue paying their employees, and it was never meant to create a tax burden for businesses receiving the funds. With the passing of the Consolidated Appropriations Act in December 27th of 2020, there was more clarity on how the expenses covered by a PPP loan will be treated. So previously, anything you spent your PPP loan on was not going to be tax deductible. Now, these expenses are tax deductible, and simply put, your PPP loan will not affect your tax filing process. So forgiven PPP loans are not taxable, and historically, if you had a business loan and it is forgiven, that is automatically taxable income. It's been in the Internal Revenue Code forever. However, that's what's so unusual about the Paycheck Protection Program loans. They break from that code. Congress specified, and the IRS has clarified, that forgiven PPP loans will not count as income. This applies whether your entire loan is forgiven or just a portion. So this loan is to provide businesses with the money to keep running and continue paying employees, and not to create a tax burden for businesses receiving the funds. So simply put, your PPP loan will not affect your tax filing process. Now, though Congress has walked back the IRS's stance on a PPP and its relationship to deductible income, that doesn't necessarily mean you can leave those funds out of the conversation on your 2021 and 2022 taxes. Whether you receive PPP funding in its first iteration or later on in 2021, you should be very careful when it comes to taxes. There are still a lot of unanswered questions, and some of these questions, they stem from the confusion in the PPP application process. So in some cases, application woes meant businesses received money that they weren't qualified for in the first place. For example, a company might have stated that it had employees when it only had independent contractors. And while that may seem like a case of semantics to the layperson, that kind of difference could have major implications when it comes time to file business taxes. And let me just talk a little bit right at this point about how the infrastructure bill did impact PPP. PPP had two draws, as I said, and there was a lot of money that was coming back into the PPP coffer because of the fact that people either had gotten the money incorrectly and were repaying it back, or there were a lot of instances where money was coming back into the program. So a lot of people were hoping that there would be a third draw. But when the infrastructure bill was signed, that the infrastructure bill came in and swooped up all of that extra money. So where people thought there might have been a third draw with PPP, it went away when the infrastructure bill, in order to find funding for that bill, swooped in and took away all of that money that had been returned to the program. Now, I want you to know that how funds were used is also important to keep in mind. So any money that the business owner used to pay something else that is not included in the PPP requirements, well, that will have to be reported as income and expenses in their business tax return. So clear and concise bookkeeping is critical. Your signed PPP loan contract stated that you would produce monthly government-ready financials, and you are required to have bookkeeping in place. If you don't, you could suffer penalties and fines or trouble with an audit. It's always good to have separate accounts to identify your PPP loan, just to keep it segregated from the rest of your expenses and your costs. And it is important to adjust your tax planning estimates to include any PPP expenses that were formerly non-deductible. So if you did receive a PPP loan, expect a tax audit. Now, the SBA and the U.S. Treasury have announced that all PPP loans in excess of $2 million will be audited. Loans that are less than $2 million are subject to an audit, and much lower loans have been and will continue to be scrutinized. There is a higher probability that the IRS will audit you. And the IRS has also developed a hotline for anonymous callers to report any possible fraud. So how do you ensure a smooth audit process? Well, first of all, please don't procrastinate. Begin compiling your documentation as soon as possible. Keep all your records, your receipts, your statements, your payroll records, and PPP documentation should be kept on file for at least 6 years after your PPP loan is fully repaid or forgiven. Make copies to send, but always retain your originals, and hire a CPA who can represent you and defend your business against the IRS if it's necessary. So here's some frequently asked questions. Does my PPP count as taxable income? No funds from your PPP loan, whether forgiven or unforgiven, are counted as taxable income. You will also be able to claim a deduction for expenses using your PPP funds. If my PPP loan is not forgiven in full, does that mean it counts as taxable income? As with other business loans, funds from your PPP loan that are not forgiven do not count as taxable income. Can I write off payroll and other business expenses if I used a PPP loan to pay for them? If you received a PPP loan and your loan was forgiven, you can write off payroll and other expenses that were paid for with these funds. Expenses that were not paid using PPP loans funds can be written off as usual. And even if your PPP loan was not forgiven, payroll and other business expenses may be written off on your tax return. Can I use my PPP loan to pay business taxes? No. Funds from your PPP loan may only be used to cover payroll costs, utilities, rent or lease payments, or mortgage interest. PPP loan proceeds cannot be used to pay business taxes. Can I defer payroll taxes and receive a PPP loan? Businesses that have received a PPP loan can still defer payroll taxes through the end of 2021. Half of the deferred payroll tax amount must be deposited with the IRS on December 31st of 2020, with the other half due by December 31st of 2022. All employers may take advantage of this payroll tax deferral, including employers who have received a Paycheck Protection Program loan. Will PPP loans be audited by the IRS? As I said above, according to the U.S. Treasury, all PPP loans that exceed $2 million will be audited, and the IRS may also audit all other loans. So it's always best to be prepared, even if you received a much smaller loan. Now, one of the nice things about living in New Mexico is that they don't tax. New Mexico does not tax your forgiven PPP loans. We know it's not taxed at the Fed level, but there are some states that do tax, and New Mexico happens to be one that does not. Now, please be sure that you confirm this with your CPA. They are the the authority on this. This is simply a map that I pulled off of the internet, and things can and sometimes do change, but at this point in time, they were not taxing it. So now let's talk about the EIDL, which is the Economic Injury Disaster Loan. The EIDL also got hit by the infrastructure bill, as most things did. And the Economic Injury Disaster Loan is a loan option. It's available through the SBA. Now, the PPP was SBA money, but you went through a lender. With the EIDL, you go directly to the SBA, and it's to help businesses that were struggling with financial hardship due to COVID-19. And though SBA disaster loans have been available for years, the EIDL was signed into law in March of 2020 as part of the CARES Act, which was passed by Congress in order to provide emergency relief to American workers and small businesses. But as of January 1st of 2022, the SBA is no longer accepting applications for new COVID EIDL loans or advances. The U.S. Small Business Administration will accept and review reconsideration and appeal requests for COVID EIDL applications that were received on or before December 31st of last year. The reconsideration or appeal must be received within the timeframes in the regulation, and this means 6 months from the date of decline for reconsiderations and 30 days from the date of reconsideration decline for appeals, unless funding is no longer available. So borrowers can request increases up to their maximum eligible loan amount for up to 2 years after the loan origination date or until the funds are exhausted, whichever is soonest. Now, last I checked, there was still COVID money in the EIDL business or the EIDL program for COVID. It's just that the program did end. Now, the EIDL is a loan, and it's treated the same as any other business loan as far as taxation is concerned. In other words, funds from the EIDL are not reported as taxable business income on your tax return. Now, the EIDL Injury Disaster Loan is a loan option that's available, as I said, through SBA to help businesses that were struggling with financial hardship due to COVID-19. Though the SBA disaster loan had been available for years, the EIDL loan was signed into law in March of 2020 as part of the CARES Act, which was passed by Congress. But as of January 1st, 2022, SBA is no longer accepting applications for new COVID EIDL loans or advances. Now, small businesses that were impacted by COVID-19 were eligible for what's called a targeted EIDL advance grant of up to $10,000, as well as a supplemental targeted advance of $5,000. These grants do not have to be repaid. The SBA encouraged all eligible businesses to apply. The grant program was part of the initial CARES Act in 2020, but funds again were exhausted within weeks. So in December, Congress allocated additional funds. Now, to be considered for one of these grants, your business had to meet the eligibility requirements and applied for an economic injury disaster loan. However, you did not have to get or accept the EIDL loan in order to get the grant. As of January 1st of 2020, SBA is no longer able to accept new applications for the EIDL loans or advances, but they will continue, and this is important, to review and approve targeted advanced applications that were received prior to December 31st of the 2021 deadline. And so as of January 1st, they can no longer review or approve supplemental targeted advance applications. As of January 1st of 2022, declined targeted advanced applicants may submit one request for revaluation, and the deadline for reevaluation requests is February 15th, 2022. Important dates if you're trying to get some of these grants. The SBA continues to offer other funding options for small businesses, including traditional SBA loans. Now, how do I qualify for a targeted EIDL advance or grant? You needed to be located in a low-income community, and you had to have suffered an economic loss that was greater than 30%, and you have to employ not more than 300 employees. So that's how you were able to qualify. Now, applications, again, were accepted through December 31st. The new 5,000 supplemental grants, the American Rescue Plan included $5 billion in funding for those. For the hardest hit businesses, and how could you qualify? You had to have suffered an economic loss of greater than 50% and employ not more than 10 employees. That's a lot of small businesses in our state. This supplemental grant was in addition to the 10,000 targeted EIDL, and you needed to apply for those by December 10th of last year. Now, initially, funds from the EIDL advances were to be reported as taxable income, and this decision was reversed under the Consolidated Appropriations Act. It does not need to be included in your taxable income when you're filing your taxes, and additionally, qualifying expenses can be written off to lower your tax liability. Legislation clarifies that EIDL grants are not taxable at the federal level, that businesses who receive them will not be denied a tax deduction for qualified expenses paid for with these funds, and that EIDL grants will not be deducted from PPP for loan forgiveness purposes. So check with your tax advisor about tax implications at the state or local level. Now, this is a good question. Will EIDL loans be audited? When you receive your EIDL loan, you agree to spend the funds provided for certain business expenses. And as part of your loan agreement, you agree to maintain records and provide these records to the SBA to be audited if necessary. While there is a chance you may not be audited, please don't skip this critical step. Maintain your records and be prepared to respond if an audit occurs. Does a grant count as taxable income? In most instances, grant funds are not counted as taxable income on your federal tax return. Can an EIDL loan be forgiven? No. EIDL loans, not advances, must be repaid over 30 years. And unlike PPP loans, there is no forgiveness process for these loans. So let me now talk about the ERTC. And I'll tell you a little bit about why this is my favorite of the three programs, because I think most everybody that's on this webinar right now can qualify if they haven't taken advantage of this. So let's go into, and even though the program is now gone, you still can retroactively go back and claim some of this money. And I highly encourage you to do it if you're not taking advantage of this at this point. Now, the employee retention credit. It's a tax credit. It was first put in place last year, actually, in 2020, as a temporary coronavirus relief provision to assist businesses in keeping employees on the payroll. Now, the ERTC was originally set to expire on January 1st of 2022, giving employers the ability to claim it for all 4 quarters of 2021. Since the ERTC offered savings of $7,000 per employee per quarter in 2021, this meant employers were eligible up to $28,000 per employee in tax credit in 2021. However, on November 15, 2021, the Federal Infrastructure Investment and Jobs Act was signed into law. The Physical Infrastructure Law includes a provision moving up the expiration date of the ERTC from January 1st of 2022 to October 1st of 2021 to offset, and again, they were scooping up money wherever they could find it to offset the infrastructure spending. In other words, they terminated the ERTC before the 4th quarter of 2021. The ERTC now only applies to 3 quarters instead of 4 last year, or 2021, meaning the maximum available ERTC per employee in 2021 is now $21,000 instead of $28,000. Still, that's a good bit of money, but it is restricted now. Now, one of the important things to understand is there were different rules between 2020 and 2021. In 2020, you had to have 100 or less qualified full-time equivalent employees. In 2021, they upped that to 500 or less. In 2020, the tax credit was up to 50% of $10,000 or $5,000. In 2021, it's 70% of $10,000 or $7,000. This credit is available to businesses with fewer than 500 employees, 100 in 2020, who either suspended or partially suspended their business due to COVID-19 because of a government order, or, and it's not and, please understand, this is or, they experienced a 50% for 2020, a 20% for 2021 decline in gross receipts when compared with the same quarter in the previous year. There were a series of New Mexico government health orders in 2020 and 2021, and each order was effective for different dates. For details on who was impacted and the dates when the orders were effective, there is a website here that you can go to, and it gives you in excruciating detail all of the orders that were put in place by the government. And you can find in that list where it applied to you, particularly in that first bullet where suspended or partially suspended their business due to COVID-19 because of a government order. Now, these tax credits are incredibly valuable because unlike a deduction, which reduces your taxable income, tax credits reduce your tax liability on a dollar-for-dollar basis. This credit is calculated per employee and is 70% or 50%, depending upon which year, of up to $10,000 in qualified wages paid per quarter. Qualified wages include the proportion of your employee's earnings that you pay that was reported on IRS Form 941. Now, is this credit taxable? Yes and no, it is. The ERC credit is subject to income tax. Wages on the claim credit must be reduced by the amount of the credit, which results in the credit being taxable income. Reduction in wages may also impact Section 199A eligible wages for purposes of the 20% qualified business income deduction. If the credit is claimed on 2020 payroll taxes after the tax return has been filed, or this would also be the same for 2021, an amended income tax return may be required to accurately exclude wages that were reduced for the ERC. And again, there's no double dipping between PPP and ERTC, even though they are both payroll programs. So let me give you an example. And this is a theoretical company. It's one that I made up in my mind. And the name of this company is Star Technical Support. They're a small business in Roswell, New Mexico. And when comparing quarter 2 of 2020 to quarter 2 of 2019, Star Technical Support experienced a 55% decrease in gross receipts. Now, in order to qualify in 2020, a greater than 50% decrease must be met, and the business qualifies for 2020 ERTC. But in quarter 2 of 2020, Star also received a $12,000 PPP. Star Technical Support has 5 employees, and each full-time equivalent employee is paid $8,000 per quarter, and that includes their health insurance benefits. In quarter 2 of 2020, Star paid their employees $40,000. That's the 5 employees times the $8,000, which is $40,000. ERTC at 50% of qualified wages, so 50% of $40,000 is $20,000. But you have to subtract out what Star received from their PPP, which is $12,000, but you still get a credit of $8,000 for ERTC. Here's another example. Again, a theoretical company. It's Fred's Fantastic Car Wash, and they're located in Los Lunas. Now, when comparing quarter 1 of 2021 to quarter 1 of 2019, Fred's Fantastic Car Wash experienced a 25% decrease in gross receipts. And in order to qualify in 2021, a greater than 20% decrease had to be met. So this business qualifies. Fred's Fantastic Car Wash has 10 employees. Each employee is paid $7,000 per quarter, which includes their health insurance benefits. In quarter one of 2021, Fred paid their employees $70,000. The ERTC at 70% of qualified wages is 70% times 70,000, which is $49,000, with an annual estimated credit for 2021 of $147,000. It's not money that you want to walk away from if you can apply for it. So there's a great deal of difference between the 2 years. So if you're going back into 2020 to get some of this money, you're going to have different requirements as opposed to 2021. So in 2020, you had to have less than 100 employees. In 2021, they upped it to 500. In 2020, it was a 50% decrease in gross receipts. In 2021, it was 20%. And in 2020, a lot of numbers going on here. In 2020, the wage credit per employee was 50%. And in 2021, it's 70%. Again, great. They really, really increased the benefits on this program between 2020 and 2021. So if your business was not in existence in 2019, you can use the average quarterly wages that were paid in 2020. Now, exclusions. You cannot use the owner's pay or the owner's relative's pay when calculating wages. You file to apply this credit, you use your standard quarterly form, your 941. Now, if you haven't taken advantage of the ERTC in either 2020 or 2021, you can file retroactively using Form 941-X, which is the adjusted employer's quarterly tax return. Now, how long do I have to file for tax credit? Latter of 3 years after the original filing or 2 years from paying the tax. So you have time to take advantage of this. But please get professional guidance and support when filing. There are a lot of nuances in filing for the ERTC. Get advice and help from your payroll expert, preferably a professional who is well-informed or on current interpretations and laws. Now, I know there are a lot of companies out there, payroll experts out there, who will charge a certain percent of whatever credit they get back for you. You can also go to your CPA that can also give you, will charge you, obviously, but they won't charge you a percentage. They're not allowed to by law. Your CPA, you can't charge a percentage, but you will get charged. But it'd be worth it to get some of this money if you're owed, if you can. Now, while the ERC is certainly a taxpayer-friendly relief provision, the IRS is not just giving these dollars away. They're looking at taxpayer submissions both on the front end and then auditing them later down the road. So the best practice is for businesses to provide contemporaneous documentation now when first determining whether they qualify. And so in order to avoid headaches and heartaches down the road, businesses need to have counsel to properly and fully document and paper how the business qualifies for the ERC. Business owners need to be aware as to whether their company qualifies for the ERC. And again, please don't miss out on this terrific tax incentive. And I think it's one of the under talked about of all the programs that are out there for COVID. So what are some of the frequently asked questions? Well, I can't claim ERC if I've already claimed PPP or gotten my PPP loans forgiven. Well, now you can claim both. Congress in the Consolidated Appropriations Act, they removed the limitation on only claiming one or the other. PPP will only account for 2.5 times your monthly payroll expenses and is meant to be spread out over 6 months. And believe me, if you applied and qualified for PPP, chances are you were also qualified for ERC. And this leaves plenty of uncovered wage expenses for claiming ERC. My business did not have a drop in gross receipts of 50% or more. The CAA has changed the qualifications so that a reduction of 20% now qualifies. But remember, there is also another way to qualify for ERC if your business has been subject to a partial or full suspension due to a government order. You can qualify for ERTC. My business was not shut down during the pandemic. Even a partial suspension order by the government, the feds, the state, or local of your business could potentially qualify you. A partial shutdown, a disruption in your business, the inability to access equipment, having limited capacity, shutdowns of your supply chain, and goodness knows we've all kind of experienced that in our businesses, or vendors, reduction in services offered, reduction of hours to accommodate sanitation, shutdown of some locations and not others, shutdowns of some members of a business are all scenarios that still potentially qualify you for the ERC. Now, key considerations are that due to the government-ordered partial or full suspension is or was, your business was not able to continue its activities in a comparable manner, and did that result in a more than nominal impact on your business operations. Remember, the partial or full suspension is an alternative way to qualify for ERC, separate from the reduction in gross receipts test. Well, my company was deemed an essential business, so I don't qualify because of business suspension. Even if your business is deemed essential, an impact or change in your business may still qualify you. For example, even if you were open, but your vendors were closed down, or you can't go to a client's job site, you may still qualify. Or alternatively, if part of your business was considered non-essential and was impacted by a government-ordered suspension, you may also qualify. Well, my company has grown during quarantine. This isn't something I should take. Well, that's great news that you grew, but if your company has grown during quarantine but experienced a full or partial suspension, there are expenses that may qualify you. Well, sales have rebounded for us in Q1 of 2021, and I can't qualify for this credit. With the introduction of the CAA, you have the option to look at 1 quarter prior to determine qualification. This means you can determine eligibility based on lost revenue in 2020. And also, if you were subject to a full or partial suspension, you may also qualify regardless. We were in losses or do not have any tax liability. Again, this is a refundable credit. In practice, this means that any credit overage above tax liability is sent to the taxpayer or business owner as a refund. Well, my company has grown to over 500 employees, so we are not eligible for ERC. The employee count restriction is based on a full-time equivalent of employees, which is a more involved calculation than just counting everyone in your office. If you paid any employees to not work or to work less than the hours for which they were paid, then the employee count restriction would not apply for those employees. I'm a charity, and the ERC is only for businesses. The ERC also may provide significant benefit to charities, churches, nonprofit hospitals, museums, etc. Charities can be particularly good candidates for the ERC. Well, let's talk a little bit about taxes. The failure to document, the tax man cometh. The ERC is a refundable tax credit, and it provides robust benefits. And if you had to draw up a tax provision that makes the IRS lie awake at night, and we all want to do that, it would be a refundable tax credit involving real dollars. Again, there are a lot of nuances in filing for this credit, so make sure you work with a payroll professional to make sure you get the full credit that you are eligible for. So let's recap. What is the process? Well, Congress votes, they enact laws, and they provide government funding. Then the IRS, the Small Business Administration, state and local governments, they look at those laws, they interpret them, and talk about and also interpret the tax implications. There are new forms and reporting requirements. CPAs follow these interpretations and provide guidance to the taxpayer. What's the result? Confusion. There's a lot of restating, reclarifying, misinterpreting, as well as conflicting guidance. So your taxes are likely to look a little different than they normally do. This means you're probably going to deal with situations you've never seen before, including forgiven loans, grants, and unemployment benefits. So record keeping is exceedingly important. accurate and up-to-date set of books, such as your balance sheet and your income statement. Track and categorize all your business expenses on both the balance sheet and your P&L. Your receipts and invoices should be digitally filed and recorded, and take the time. It's well worth the effort to be able to see where your money is going and ensure that you'll be able to get the most of your eligible deductions come tax season. Now, I'm going to repeat myself a little bit here, but please keep in mind that information is changing rapidly, and it's based on current understanding of the programs. It can and likely will change. Almost every time I come out and give this webinar, I have to modify and change some of the guidance. And although we will be monitoring and updating as new information becomes available, please do not rely solely on this presentation for your financial decisions. We encourage you to consult with your lawyers, your CPAs, your payroll experts, and your financial advisors. Make sure that whomever you consult with, lawyers, CPA, payroll experts, or financial advisors, that they are up to date on the most recent guidance from SBA, the IRS, or the US Treasury. That concludes the presentation for today. I think we're now into the Q&A portion of the presentation. I see that we have three comments in the chat, but I don't see any Q&As. Is that true?
Yeah, that's correct, Peggy. That is correct. I just chatted through some information to everyone. We'll also send that through to you via email. I don't see anything in the Q&A. Don't be shy to ask any questions. We love questions around here, so feel free to ask us any questions you may have. Aside from that, Peggy, I think we are good to wrap this up.
Okay.
Yeah, still not seeing anything in the Q&A. So did you have a couple more slides after that, or?
I wanted to thank everyone for attending. Hopefully you found this useful. It'll give you some ideas, some questions to ask. Go out there, and there's a lot of information out there, and take advantage of all of these programs, as much advantage as you can, particularly now that things are wrapping up, as things are wrapping up. So talk to your CPAs, whatever you need to do in order to get some of the money that you deserve as a small business. That's it.
Thanks so much, Peggy, and everyone, thank you for your attendance. The presentation was great as always, such wonderful information, and just wishing everyone a great afternoon and upcoming weekend here soon. And thank you again for your attendance.
Thank you, everyone.